Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Hey everybody, this is Sam Barker with Aaron Kennedy, Brent Bible, and Henry Knowles III. Black and White Market Minute. We'll keep this one a little bit shorter than last time probably, but we'll see where we end up. And Aaron, do you want to start us off?
No, I don't. I want to hear about what the interest rates have done. You know, where should you be if you're going and talking to your banker? What have interest rates done this week?
So since last week, they haven't really changed much. 3-month CD should still be around that 4.3%, almost 4.4%. So if you're not getting that, again, give us a call. We want to get you the best rate that you can get. 2 to 10, you know, it's hadn't really, like I say, not much change, a little lower, but like I say, it's never, with the rates over 4%, we got used to those 5% rates, and 4% is still a really good rate to get. So,
Are we still inverted anywhere?
It's kind of odd. So 2 to 10 last week, we were pretty, it was pretty typical. Kind of inverted back again on 2 to 10 year treasuries. Again, you go back to those shorter term, those 3 months, 6 months. That's the best rate you're going to get, and like I said, that's the way to go right now.
It's kind of odd, you know, getting these readings every single week because you know, every single week it doesn't feel like a whole lot's changing. You know, but we got to remember when it's interest rates and what Brent is really quoting, whether it's CDs or Treasury or anything, this is a discount rate, and I know that might be a little bit complicated, but basically the higher that rate is, the less future growth and future interest rates or future income is worth. So we sure don't mind interest rates coming down a little bit. It's easier on everybody. Just think about your mortgage payment. You know, mortgage payments are going to come down, faster to pay off your debt. So I mean, it's very helpful for the economy. But you know what? Big picture, nothing's really changed. It's just like the market, up and down and up and down and up and down. And this week really hasn't been any different. It's absolutely incredible what the market is doing. It feels like I got bruises all over my body. I got broken bones, everything else, and then you go start looking at reports, and really we're about flat. You know, not much has happened at all.
Yeah, and if you look at the auctions, not a whole lot of people I think pay a close attention to the Treasury auctions, but I've been kind of keeping a closer tab on them lately. They've been pretty solid. They've been healthy. If you get, you know, the way that you need to think about it, the government goes out and says, I need $50 million, and this is just round numbers, $50 million of funding. Y'all start bidding for it, and there will be $400 million worth of bids trying to get, hey, I want to buy your $50 million of funding at this. You know, so the ratio, you're getting 300% of what you're trying to fund. That means that you get to pick some good rates, the best rates that are being offered. So we still get healthy offerings on those fundings and financing.
I love that. Sam brought up a great point because, you know, we hear a lot about nobody wants the U.S. dollar. What happens if everybody starts selling the U.S. dollar? And, you know, once those bids dry up, nobody wants to buy those treasuries. That's really when we should be worrying. But if everybody's knocking down the door to buy at these auctions, everything is healthy. U.S. dollar's just fine. World trade is just fine. U.S. dollar's still the main instrument for all trades around the world. So thank you for that, Sam. While the U.S. market is kind of beat up, there are some things that feel good. So I want to bring on somebody that can give us a little opportunity or opportunistic outlook.
He didn't quite fall asleep when we were talking about fixed income.
Yeah, he's still with us.
He's been nervous the whole time. Yeah.
All right, here's your rundown for the international markets. I don't really want to talk about week-to-week returns because that's really pointless. But anyways, year to date, yeah, the trade back to the international markets is still working. You see over in Europe, the FSTE over in the UK is up around a little over 13% year to date. Looking at the DAX in Germany, almost 20%, and then the CAC over in France up about 9% year to date.
That's so strange. Not used to that at all.
Yeah, I mean compared to the U.S. markets, just still down year to date, which we haven't really experienced the last 2 years. S&P down a little around 4% as of right now. The Dow Jones down about 1.5%, so pretty flat on the year, and then the Nasdaq down about 6.5% year to date. So we're still seeing that trade over into the international market still working. We're still seeing the inflows over there. So markets around the world are definitely behaving a lot different than they are over here.
Yeah,
Things are so strange. I early in my career, before children and gray hair and readers, my most aggressive portfolio was chock full of international assets. And I'm trying to think, but I think that was 2005, 2007 era. And that's really when, for my memory, that's the last time that international markets were actually, I hate to say helpful, but the way to invest, the bullish answer. I mean, give me some kind of historical backdrop on that stuff.
These averages are over the last 20 years. So the S&P, the average P/E ratio for the S&P is traded around. We've averaged around 15.9 times earnings, while over the international markets are averaging about 13. So still less, still I guess technically cheaper in international markets on average over the last 20 years. Here's why recently we're seeing this huge flow into the out of the U.S. market and into the international. Is because the current PE for the S&P 500 is up to about 22 times earnings right now. Historically, that's high. I just said that the historical average is around 16, but then still the current earnings, the PE ratio over for the international markets is 13.6 right now. So definitely technically cheaper the international markets are. So I think that's why investors are seeing that opportunity over there.
Yeah, that's way more than 50% cheaper. It's just hard to wrap your head around how cheap some entire asset classes, and international is one of the big ones. Small caps are one, but just international as a whole has just been beat to death, and it's kind of exciting to see them starting to move. I think we touched on it last episode on the difference in the industries and sectors and that kind of thing. But I think Sam was showing me a report today, and the multiples, or how much we had to pay per dollar of earnings or cash flow or any of that stuff, has been a steady drop since, what was that year, 09, 10, somewhere around in there.
Yeah,
it's been way more than a decade. So there's been lots of investment managers that have lost their job betting on the return to the mean, because we all say, hey, we need to buy small caps because, law of small numbers, small companies can buy or can grow faster than big companies. Well, that hasn't turned out true over the last decade or so. International, those should be on average close to the same as U.S. Nope, not even close. What'd you say, Henry? 22 to 13
as of right now, and that's with this even recent run up in the international markets. It's still technically book value a lot cheaper than the U.S. markets right now.
Do you imagine how easy our job would be if we could say, hey, let's diversify into some international markets, and we're going to get some positive return? It's been a long time since we could diversify international, but we weren't going to get any returns.
Well, and it looks a little bit, if you look at the past couple of years, the concentration of the U.S. market has been so concentrated. And if you think, I cannot stand that concentration, I need to diversify, you've underperformed by a large margin for the past, especially 2 years. 2022, you probably did pretty good relative to the S&P, but
Yeah.
short term, the recent history, if you were any kind of a diversification manager, you look, not great under the spotlight compared to some of those more concentrated, your NVIDIA positions and things like that.
Well, I can tell you this: it is so bad that most investment managers have given up. You invest in U.S. or you're going to underperform, and you can't argue with them because that's been been the output. That's what's happened. But to Sam's point, we are definitely a lot more concentrated, and there are some fantastic companies overseas. It's just different. When you have some of the powerhouses like we have here in the U.S., man, who can argue with that? There's sure no Microsoft in Germany or Amazon in France. It's just difficult. So what do you see going forward?
I think what's been working is going to keep working, at least short term. Long term, don't know much to say about that, but I'm still a believer in the U.S. markets, always will be. And I don't think this return to the mean happens anytime soon. So,
Henry, I'm liking you more and more every day. I know I brought this up. I got this little black ball. Does everybody remember the little 8-ball? I have this little 8-ball in my office. When someone will come in and ask me for a long-term prediction, I just say, hey, hand me that little ball. Let's see what happens. Try again next year. Long term, it's hard to really accurately project anything.
If we go back to the concentration argument, I'm looking at the weight of the top 10 stocks in the S&P 500 historically back to 96. In 1920, we were more concentrated than the dot-com bubble. In 22, we kind of, quote-unquote, reverted back to the mean and got back down to the 2000s concentration. And then as of January 31st, I don't have our February and March numbers yet, but January 31st, we were more concentrated by a large margin than we've been, with the exception of since 2020, than we've been since at least before 96. I don't have the numbers before then. So
it's insane.
And then whenever we're talking about valuations, if we're talking about PE ratios, there's one that's called the forward PE, and that kind of, expectations over the next 12 months. And then you have the trailing PE, is the current prices. If you look at the current PE as of January, and we've pulled back since our January numbers, but the top 10 stocks in the S&P 500 was 142% above their average.
Wow.
Since 1996. So if you look at the average from 1996 to current, they're 142% above average before this recent pullback. So it's just, if you look at, our value type investors, they're feeling pretty good right now because I think that they're actually doing good year to date relative to your growth guys who would have been more overweight. Tesla, which is down over 50%.
Yeah.
NVIDIA,
It is
which
coming
got
down.
kicked. Yeah.
One thing that really surprised me is if you look at the All Country World Index, how much of that is U.S. markets right now? And All Country World is pretty much not every investable asset in the world, but the bigger ones. And I remember starting out, we were 52. The U.S. was 52%. And I'm not saying we're 3/4, but we're dang near 3/4 of the world's value of stocks right now. That's how much outperformance that's been in the last 20 years. And that's just crazy to think about.
Well, and 20% of that is going to be information technology, which is those same names.
Yeah, that's the U.S., the leader in technology, the leader in semiconductors. What's driving the world right now came from the good old USA, and we're getting compensated for it. Our stock prices are going through the roof, but it's getting a little bit silly when you're looking at global investing. So,
Well, and you talk about
what do you do?
Talk about prices going through the roof. I know that we were overjoyed to get some phone calls over the past since our last podcast about, hey, let's get some money to work at these better prices. You know, so
We appreciated that.
As boring as it may seem. I think about the.
Thank you, Brent.
You're welcome. I think about Henry and Sam are probably too young, but I think back to that Clear Eyes commercial, that real monotone guy. And I'm like, I don't need to sound like that guy when I'm on here because I'm really going to put him to sleep. And I was also thinking about how can we make fixed income more exciting?
You can't.
But
That's why we stuck you there.
I'm not an exciting guy. So, but it does play a vital role in your portfolio, of course. And Aaron talks about that dry powder. And correct me if I'm wrong, it's a big source of the dry powder.
Yeah.
So
Everybody gets it backwards. And I've told you this too, Brent. You want to get the heavy sales guys. The rah. You go to the stock side. If you want this is what's happening in the economy and this is what you should do. If you want the brains behind everything, you go to the fixed income guys. That's where all the power is. So,
well, and they still get paid at the end of the day. If the world falls apart, markets go under, those fixed income guys, they still get paid at the end of the day. So.
And we're still looking for the brains, and so that's why we're in search of my replacement.
Yeah, I know. We're still hiring if anybody needs a job.
And Henry's asleep. So.
I want to go back a little bit to these recent prices. I'm looking at a chart here, annual returns, and then the intra-year declines. 2020 was a crazy time with COVID. We ended the year, the S&P ended the year up 16%. But right around March, you could have bought the S&P at a 34% discount to what it ended the year at. And so if you think about these buying opportunities, if you think about these market dips, you hear buy the dip. There's really two kinds of investors, and we have a chart that demonstrates this awesome. Retail investors tend to do the opposite of what you should do. And then we have the institutional, more asset manager types who are aware of their biases and try to they have teammates who call out their blind spots. And those guys, they tend to do a little bit better than the retail, because retail, they're going to buy the dip until the dip is longer than they thought it was. Then they're going to sell and try to buy lower. By the time they think that they can sell and buy lower, usually that's around the bottom. So these opportunities to buy that you get, they're huge opportunities. You can expect any average entry-year decline of 14 to 18%. The annual volatility is 18% of the S&P.
18%.
So, yeah. Year
in, year out. At some point, if you can pull the trigger, you're going to get an 18% discount. I think that's the key. If you're going to hold cash, if you're going to hold anything that's risk off, if you're doing it because you're scared, it's because your asset allocation is wrong. If you're risk off on anything, it needs to be because you're searching for that next great opportunity. And as long as your eyes are looking forward and you want better things in the future, you'll be able to see these opportunities. If you're scared, if you're worried, then you're blinded because you think that this is the way it's always going to be. It never is. It never is. I can't tell you how many times I've had a conversation with somebody that says, well, what happens if it goes to zero? It's a bad time because, it's a scary time, and you definitely don't want to dismiss, or how do you even say that? You don't want to take their feelings and tell them they're crazy, because it is a scary time. But what would happen if everything goes to zero? I'm going to be wearing a deerskin coat and, picking plums and, eating mushrooms.
I think we'd have much bigger problems if the S&P went to zero.
Yes. That's what I'm saying. But at the end of the day, we're humans, and we always want what's better. It doesn't matter if it was, 100,000 years ago. Technology advances. We want what's better for our kids. We want better things tomorrow. So we always got to keep that in mind. If you can realize that, and believe it. You know, these little downturns are huge opportunities, and they don't come along too often. So you need to be licking your chops when this kind of stuff happens. So the people that did call and say, hey, you know, see the market's beat up, let me take advantage of it, you're way ahead of the curve, and you're going to come out way ahead of everybody else. So that was impressive. Thank you.
Yeah. Talking about market dips, what do you have over there in front of you, Aaron?
Oh, okay. The main thing I wanted to talk about was valuation. I know I've beat this like a dead horse of how expensive stocks are. We're in the 99 percentile. It's only been 3 times that we've been this expensive. But I kind of want to take the other side of that and really talk about how I've screwed up in the past over this. There's a little company called FICO, and if you've ever bought a house or in any large asset, you know about the FICO score. That's basically your credit score that a bank can pull up on you. And every time a bank does that, you know, their FICO picks up a couple of pennies. And they're pretty employee-like, very high technology company. And what did I say earlier? There's 2 things that print money in this world like there's no tomorrow. It is FICO and the U.S. government. There is no end to the money that they can print. But I was always scared to buy FICO because how expensive they were. I mean, even in 2015, and I'm sorry I didn't bring my readers today, so Henry, help me out.
I see here back in 2016, the PE ratio for FICO was about 35 back then. Fast forward 4 more years to 2020, we're sitting at 64. 2022 down to 42, and then for 2024 the PE ratio was up to a whopping 97.
97, yeah. And I was scared to buy at 35. I was scared to buy at 40. You know, and sometimes kind of the point I'm trying to make is sometimes companies are so far ahead of everybody else that they're worthy of that high valuation. Hope I can bring up some conversation in here, but the great Warren Buffett, Berkshire Hathaway, he was a cigar butt investor. Yeah. So the cheapest of the cheap. And
he was buying companies to sell their assets and make a fortune.
Yes.
Yeah.
So you buy companies that are worth absolutely nothing but the cash on their balance sheet, and then hopefully you get a tick and sell for more. And he was successful at doing that. He was very successful at doing that. And then he met a gentleman by the name of Charlie Munger. And Charlie said, you can't do this because there's not enough companies in the world this small that you can continue this strategy. And Charlie Munger started helped him move to buying quality companies at a fair price instead of companies at dirt cheap prices. So there's a thing that he says, it's better to buy a great company at a fair price than a cheap company at an okay price. So there's something like that came out since Munger's happened. If I could have stomached buying at a 35 PE, which today doesn't sound bad. The market's trading at 21 or 22. You say for every dollar of earnings, I'm going to buy it for 22. If I would have bought something super expensive back there, $1 for $35, today I could sell it, or I could buy it for 80 or 96. It's stupid. And the funny thing is why we're even talking about this. FICO has grown. From back in 2015, it was sitting at $96 a share, back when it was too expensive for me to buy. You know, it hit a high of 2,382 in 2025, but it was too expensive at $96. Anyways, it's come down about $500. It's priced around $18.20, and I grabbed Sam and I was like, look here, it's coming down, it's coming down. But it's still priced in the nosebleed valuations. But this is a company the cash that it's putting in its bank account at the end of the year, they're throwing back about $673 million, which is almost 40% of the revenue. 40% of everything that they make goes back into their bank account, and they pay taxes. You think about that. I mean, this company is phenomenal. They've averaged about a 32 return on invested capital, and right now they're at 42. Fantastic companies that can do what they do extremely well and turn their ideas into hard cash that goes back into their bank account are worth more than the average company. So as much as I talk about valuation and how expensive things are, we got to remember sometimes it's worth it. Sometimes the company deserves to be that expensive. And I wish I would have picked up FICO a long time ago.
Yeah, well, and if you look at their shares outstanding, I'm looking at a chart right here. They had about 76 million shares outstanding in '02, and that has dwindled down to just under 24.5 million shares
That's
outstanding.
incredible.
They're taking that cash and they're going into the market and they're buying their shares back and putting it back into the company.
Yeah, they bought back, I mean, since 2025, $401 million worth of stock. So if you're an owner of FICO and you own those shares, you know, they just bought back $401 million, so you earned or own that much more of every single dollar that goes in their pocket. You own more of every single earnings that company makes, and
It's less shares to split the earnings
yes,
by. Yeah.
yes, less owners, less shares, more in your pocket.
Well, and what does it say about the management of the company? You know, if you're sitting at a 68 PE and you're thinking, man, this is too expensive for me to buy, and they come out and they start buying up shares left and right, and you're thinking, God, they've got to be crazy.
Yeah, are they crazy,
Yeah,
or is it just more to come?
They've been doing it since 2002.
I hope they're buying right now at 1800 a share versus the 23. That, and I think they have. The stock price has come down since then, but what a fantastic job by the company leaders.
Yeah.
Really impressed by them.
Knowing their company very well enough
Yeah.
to know that even at those high valuations, it's a good.
Do we need to put in a disclosure? We do not own FICO. We do not suggest anybody buy FICO.
I can voice that if you need me to.
Yeah, please, Brent, give us our disclosure.
So
Price performance, future performance does not equal.
So in my simple overthinking mind, that there was two words that came across my mind as y'all were talking about that, and that was quality and growth.
Yes.
So,
Thank you.
I know it's very simple, very simply put, but that's all I can think about.
Just so happens
Sometimes
we have
the
a quality
simplest
growth.
mind comes out with the best thing.
They have been kind of a candidate for one of our quality growth portfolio
Yes.
for a long time, but have not gotten over that valuation.
Right. We have a list of companies of I wish this comes down far enough and we're going to jump all over it, and that's been there for a long time. And again, I'm not going to blame this on Sam. I've been the fool for not buying it.
Kind of reminds me.
Or
of,
we can blame Brent.
That's what we'll do.
I think the this PE ratio and the just the growth of the company kind of reminds me of what Amazon maybe 8-9 years ago. You're paying, off the top of my head, 200 plus PE, but the earnings were growing every year, and look at Amazon now.
Yeah.
The stock has risen while the PE ratio, the stock price has risen while the company's become cheaper, which is a really cool thing to see.
Yes.
And that's what you want to see as an investor.
Amen. Amen to that.
Well, have we cleared all the hurdles? I know that this is more of a black and white market chatter at this point. But
Market chatter.
Henry, Brent, did y'all have anything y'all wanted to add on? Cherry on top?
I think I've said enough.
Good.
I think you've said too much. All right, that'll close us up with another episode of Black and White Market Chatter on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.